Hey, good morning, everybody. Welcome to another Coffee with Kirk. After a very interesting week in the markets and the world in general, of course, it seems to be that way all the time now. But very interesting in the markets, mostly because of a potential new artificial intelligence tool that came out and really wreaked some havoc into the market. And that's sort of what we'll focus on today. Talk about that a little bit. I got a lot of questions on it right away, what it meant. As always, maybe we'll jump right into our slides here, like I always tend to do. But what we've been talking about here for quite a while, really pretty much most of 2024, I've been really trying to stay away from the Magnificent Seven. The stocks that are really carrying the stock market, mostly because of overvaluations. It seems to be it just feels like 2000 again with those stocks. Maybe it's only 99, maybe it's 98, but you just have this feeling like there's such a small group of stocks that are carrying the weight of the market. And this was sort of a graph that I saw talking about how the capital markets are leaning on U.S. equities, which is basically an elephant on a balloon, and then holding up the balloon is a couple ants. And that's what it's been. And, I've kind of stayed away in client accounts from those stocks. I've really tried to stay away from tech. And it's been to my detriment thus far. But you just have to get back to, are you speculating on the markets or are you investing in the markets? And it always comes back to me, at least everything I've always learned. And it seems like over time, it's always panned out, and great investors like Warren Buffett have kind of shown that. When you invest in something, all you're trying to get an idea of is what kind of future cash is this company going to provide me? That's the key question. Now, there's certainly a lot of variables to that, but you want to pay as little as possible for that cash flow you're potentially going to receive. That's what you want to do. That's your goal as an investor. It doesn't matter if the company's a great company. It doesn't matter if it's a sexy company, if it's got a great story. None of that matters. What kind of cash are you going to get back from that company? Now, in growth stocks, it's kind of hard to tell because sometimes they grow really fast. They grow faster than the market anticipates. And then you've got the more boring value companies where they're pretty consistent. You're not going to get a lot of earnings growth, but then you can still look at other factors to see if it makes for a good investment. Well, so the first thing I came across an article just this week by Howard Marks. You probably have never heard of Howard Marks, but I mean, he's been in the business since 1969. He talks about how really he came in right at the peaking part of the Nifty 50. So that was really kind of for everybody watching this or most people that are World War II generation or later, or maybe or maybe the boomers are later, I should say. It's the first real bubble that they ever experienced. So there were, 50 stocks that everybody said, oh, these things are absolutely they can do no wrong. They are the future. And, it was companies like IBM. I mean, IBM in the 50s and the 60s, phenomenal. But it was also, GM, just that whole saying, as goes GM, so goes the country. That was a big thing back in the 50s, 60s. So you came out of World War II, and we had really the 50s and 60s were very good times economically for the United States. And so these stocks kind of represented the future of the U.S. And the general approach was there's no price too high to pay for these companies because they're their growth was just going to be, absolutely unconquerable going forward. And it didn't happen that way. I mean, a lot of the Nifty 50 are, really struggling or almost non-existent. I mean, Kodak was one of them. I mean, Kodak came out in the 50s, the cameras, and then in the 60s they came out with the what was it? The Polaroids. So you got your photo in 10 seconds. I mean, it seemed like it was just unstoppable. But just tons of the companies from that time period don't even really exist anymore. So it just kind of shows you that you just get to the point where when people are paying any amount for the stocks, you're heading for a bad situation. Well, anyway, so Howard, he's really well known in the investing world and very well respected. And even Warren Buffett often talks about how smart Howard Marks is. And he had a really good article. If you just Google his name, it's probably the most recent article that he put out for his firm. And, one thing he kind of talked about, there's a book, Markets, Manias, and Bubbles. And this was one of the quotes. I'm just sort of cherry picking a little bit what he's talking about. But, this was sort of the approach that this book, Markets, Manias, and Bubbles, it's a very dry book, but if you wanted to really understand it, it is a very good book. But you start to, as firms or households see others making profits from speculative purchases and resales, they tend to follow. And I've been getting tons of questions on AI, Bitcoin, stuff like that. When I start to see the average folks getting a desire to nibble into it and to get into these markets, I know it's probably near the end. But anyway, it continues. When the number of firms and households indulging in these practices grows larger, bringing in segments of the population that are normally aloof from such ventures, speculation for profit leads away from the normal rational behavior to what we've been described as manias or bubbles. The word mania emphasizes the irrationality. Bubble foreshadows the bursting. So this is kind of what we're looking at, I think, with today's world. And in the article, Marx kind of goes on and says, it's not what you buy, it's what you pay that counts. Good investing doesn't come from buying good things, but from buying things well. There's no asset so good that it can't become overpriced and thus dangerous. And there are few assets so bad that they can't get cheap enough to be a bargain. So again, it comes back to what kind of cash am I going to get as an investor? And what am I going to pay for it? How expensive is it going to be? And I mentioned in a previous Coffee with Kirk a couple months back, if you bought a house, if you're looking at rentals and you bought a house right on the water, beautiful house, great community, overlooking the ocean, and then you got another house maybe in the middle of Ohio or someplace that's really cold and nothing really there. But you have to look, even though you think that house on the water, if you have to pay a premium to get into that house such that the rents aren't really driving any kind of actual profit to you, you're better off buying that place in Ohio, even though if you showed people both places, they tell you to buy the place on the ocean. You've got to look at the cash flows. The last kind of point I want to make with Howard Marks, he went on to say, whatever innovation-led bubbles we choose to examine, the result is the same. The bubbles collapse. Innovations create a new and useful layer of economic activity. The early profits erode, and most of the benefits ultimately accrue as consumer surplus. Speculators screaming this time are different are begging to be steamrolled by their own disregard for economic history. And we saw this back in the internet bubble back in the 90s and early 2000s. It absolutely was life-changing. The internet has absolutely changed every facet of our lives. And I mean, such that like my daughters, I I don't even know if they could live without the internet, honestly. Like it would just be so difficult for them to, get used to or be able to function. So the internet back then, it was life-changing. But we got to some valuations that just made absolutely no sense. So what ended up happening was it sort of collapsed. Now, all this money that was poured into the internet at the time, companies were throwing tons of money into it. Well, it still produced economic activity. It's still a good thing for us overall. It created that useful layer of economic activity. So we had built out the internet. But what ended up happening was the companies underlying all that just got bid up so high that eventually that pin came to that bubble and took that bubble out. Back in the early 2000s, it was interest rates going up quite a bit. So the Fed raised rates, all the rates went up. And at that point, once rates went up, investors started to look and say, well, I could get, at that time, you could buy a 10-year for 7.5%. You could get a guaranteed 7.5%. Inflation was very moderate, sub 2%. So that you were getting a 4 or 5% real return with no risk. Or I could invest in Cisco that was trading at 40 times earnings. At some point that sort of all changed. And once people started to look and say, well, it's 40 times earnings for Cisco really the way we want to go. Once that bubble was popped, it dropped 80%. And what did Cisco in was it was the backbone of the internet. They produced all the equipment that made the internet happen. So if you believe that the internet was life-changing, then it made sense to invest in the company that was enabling this life-changing technology. And you were going to pay whatever you wanted, whatever the price was to get into it. But what happened, again, interest rates go up. Money starts to shift to that. At that point, some of these smaller internet companies that were buying so much Cisco gear, well, they went under, but they still had massive amounts of hardware sitting in their warehouses that all of a sudden was pretty useless. So all of this Cisco gear comes back onto the market at cut prices. I mean, 50, 60, 70% cuts to what Cisco is trying to sell it. So Cisco sales go down because there's this influx of their product coming back on the market as resales. Still good equipment. And even today, I mean, Cisco is still a great company. It's still part of the Dow Jones Industrial Average. Phenomenal company, still makes all the equipment that makes the internet go. But it lost 80% at one point. So what we've seen over the past couple of years is just this AI craze where all of a sudden everybody was going into artificial intelligence. And it resulted in just a massive increase in market capitalization for the Magnificent Seven, the top stocks. And the approach of these top stocks is they viewed it as there's going to be very few winners in artificial intelligence. You have to be one of the winners. You've got to be one of the last men standing in order to make money on AI. And there's a ton of money to be made, massive amounts of money. So you can see this chart shows you for the Magnificent Seven, the amount of money that they were putting into capital expenditures directly related to artificial intelligence. And you could see they were pumping in massive amounts of money here the past couple of years. And in fact, this goes through the third quarter of 2024. So we don't even have the fourth quarter of 2024 in there yet, but they spent $66 billion on AI capital expenditures in the third quarter of 2024 alone. 66 billion. I mean, that's bigger than many countries' GDP. So they're putting in tons and tons of money in order to build the infrastructure for AI, thinking that that's going to pay dividends down the road. And then the market generally agreed with their thought process. So they were pouring in absolutely massive amounts of money without realizing any kind of substantial revenue to cover these capital expenditures. So they're not bringing in the revenue yet. It's one of those where they're saying, we're putting the money in now in order to make the money later. And the market had no problem with that and rewarded them handsomely, sending them up to valuations that just don't make sense. But again, it's a new dynamic. It is the internet times 10. It's going to change the way the world operates. Just like we heard back when the internet came out. Well, so this week, something happened that maybe changed things. And as I said just recently, and I've been saying, is I don't know when the sanity comes back to the market regarding AI. And I've been saying this for a while, but at some point it's going to. So was the release of DeepSeek that pin to the bubble. So if you don't know DeepSeek, you probably do. It's been everywhere in the news, but DeepSeek is a Chinese AI platform. And it came out and said, well, basically they built this platform for about $6 million. At 6 million, not a billion, a million. And as I just mentioned on the previous slide, just in the third quarter of 2024, the Mag 7 were spending $66 billion on AI with a B. So if this DeepSeek could produce something that basically was running as well as ChatGPT, and they did it for $6 million, well, all of a sudden, there's a game changer that's just come about. All the money that the Mag 7's been pouring into AI, maybe they've been overspending. They didn't need to be doing that. So all these companies are now faced with lost capital. They're also facing, especially for NVIDIA, extremely lower demand for their product. We'll still see, but according to what the initial reports were, the cost of input processing, meaning the cost to actually upload or conglomerate data into the AI application, was about $2.50 per million tokens. And the million tokens is basically chunks of text. So per million chunks of text, it was costing about $2.50. $2.50 for ChatGPT. For the DeepSeek, they're claiming that it's 27 cents for the same amount of per million tokens going into the input processing. So you're talking about 9 times less expensive than ChatGPT. And then for the output, the stuff that we as consumers use, so when we go in and try to get data out, you can see that 9-to-1 ratio continues to exist. So it costs you 9 times more on ChatGPT to get the data out than it does on DeepSeek's. So this has just a massive ramifications. And we really won't know, how it's all going to pan out. But it basically says that maybe you don't need to be putting in as much capital expenditures here. And again, the companies that have already put in so much, maybe it's an underutilization of capital right there. And then companies like NVIDIA that are supposedly, they have chips that they sell for $30,000 with a 90% profit margin. Well, if their most powerful chips aren't needed to build this platform, what's going to happen to their company? They've been priced to perfection. So it has some huge ramifications. And probably the biggest one is the big guys, the Mag 7s, were thinking we have to spend now so we can box everybody else out of AI. We want to control it. And we've got to be front and center. We have to be the leaders here. Well, now all of a sudden it's saying, well, maybe not. Maybe there aren't going to be just 2 or 3 big players in AI. If you can develop it for a lower cost, now all of a sudden smaller companies can get into the AI market. There's going to be more opportunity for companies to serve customers with AI. And all these Mag 7 companies, the Googles, the Apples, Amazons, all of that, they were thinking, well, eventually this AI is going to be a monthly subscription. Like right now, if you get a ChatGPT subscription, you're spending $200 a month for each seat, for each license. Well, all of a sudden that $200, what if it goes to 20? And they've spent all this money to build out their platform. So it's got a huge ramification on what's going to happen with AI. Now, you have to remember, DeepSeek is a Chinese company. And I don't believe a doggone thing that comes out of China. You can't rely on any of these companies in China, to tell the truth. And if, years back, it was probably 4 or 5 years ago, I interviewed a high school classmate of mine who eventually had started a hedge fund. And basically the hedge fund was kind of literally sending people into China to do research to show that all of the companies that were getting, Chinese companies that were getting listed on the US exchange were just making up their numbers. They were completely lying. And there was a process where a Chinese company could come in and get a ticker symbol from a US company that went defunct. And then they would trade on the US markets. Well, the US requires you to release quarterly reports and have audits done, although those audits clearly don't work when you remember Arthur Andersen and all that. But there's at least a process to try to make sure that you're not lying. And the Chinese companies just made up data. And there was a movie made about this, and my friend was in that movie. Called The China Hustle. So if you ever wanted to review that, I think you can even watch it just for free on YouTube now. But, he basically said, look, they're going to lie to us. They're going to take our money and they don't care. So this whole DeepSeek thing could be a complete fabrication. So, they're trying to find out right now if somehow China was able to buy NVIDIA's top microprocessing chips through Singapore. That's what they're trying to say. They're trying to say the 6 million number is total bogus, and it's actually much more expensive to develop it. And there's, certainly right now, somebody did some research here, and they kind of found out there were a lot more NVIDIA chips heading to Singapore. So maybe that's what was going on. So Chinese companies were essentially buying some of these high-end NVIDIA chips from Singaporean companies, and it was sort of a backdoor. So obviously the U.S. is going to look into that and see. Now, a lot of people say, well, that just proves that nothing's changed here. NVIDIA is still going to be making all kinds of money with their chips. There's still going to be a rush to build this out, and there's no way a lower level AI company is going to be able to compete. And I say, no, even if DeepSeek turns out to be that they were using chips from NVIDIA, the high-end stuff, this could be what starts to bring investors to think, well, hey, okay, maybe it didn't happen with DeepSeek, but this is how this is going to end. And DeepSeek, no matter what, has basically shown that they have developed a different way to approach AI that made the power needed to power AI less taxing. The way they structured it was such that right now for ChatGPT, it's powering up as if when you go into ChatGPT, it's powering up so that ChatGPT could answer any question that you have, every topic, all the knowledge. So that takes a lot of power. Whereas DeepSeek developed it in pockets. So I might go in and I'm going to ask about financial questions. So it's only going to take a slice of the entire universe of knowledge. A doctor may go in and just talk about medical. A lawyer may go in for legal. So they've been able to sort of pocket it so that it doesn't cost as much to run the back-end AI. And now, you know, the other thing people saying, well, they basically just stole ChatGPT's information. And what some people are saying is what China did to keep the cost down is they looked at ChatGPT. They ran millions, maybe even billions of questions to see how does ChatGPT answer all of these questions. And then they just rebuilt that. So they basically stole the technology. But to that, I say, who cares? One, there's pretty strong evidence that ChatGPT, Sam Altman, who started it, was essentially stealing IT technology from a lot of different companies to build ChatGPT. It's a conglomeration of a lot of different inputs. But the second thing, and more importantly, is if they did it, if DeepSeek did it, it means others are going to do it too. This isn't something that's going to be able to be totally contained. If I want to build a new AI platform, well, I just pay my $200 a month until I've got enough to launch my own. And then I just start tweaking it as I go. I can make it more efficient. I can make it more useful with taking all of this information and coding it. So that pin to the bubble has been there. Now, I can't say for sure that this is it, but I think this is going to put enough doubt in people's mind to say, should we be paying extreme valuations for these companies right now? Are they worth it? We're kind of back to that 1999 into 2000 when you started to look at, should we be paying ridiculous valuations for internet companies? Right now, NVIDIA has broken through the 200-day moving average and did it very quickly. So it within this week went from about 160 to down to 120. I could turn right back around. NVIDIA is a great company. It's absolutely a great company, but so is Cisco back in 2000. Cisco's still around today and still a great company today. Comes back to everything we talked about. It's what are you paying for those future stream of earnings? The other big one, this was actually surprising. Tesla released their earnings this week, and they were horrible. Earnings were down, revenues were down. And when you dig into their actual earnings, this sort of breaks out how they make their money. So in the fourth quarter of 2024, the blue on here is the money, the profits from their automobiles. And you can see for the last quarter of the year, they did make a lot of money off their actual underlying product. The red is their energy. So that's going to be, they've developed the whole structure to power up, electric cars. So they've been selling that, and that's very good. Now the ZEV, the EV credits, those are basically government credits that they get. And the whole time, Tesla's been making a lot of money just on government credits. And it could be one of the reasons why Elon is so ingrained in with the Trump campaign. He may have assessed that Trump's going to be the winner. So that's why he went that way rather than going with Kamala Harris. I don't know. I mean, maybe he just really believed in Trump, but he certainly has an incentive to keep those EV credits coming because it's an enormous part of their profit. But the weird one, a lot of their money in the last quarter of the year, non-operating profit, well, Tesla had taken a lot of their cash and put it into Bitcoin. So this non-operating profit is actually a mark-to-market of their Bitcoin holdings. So they made a lot of money because Bitcoin went up. But that leads me to the question, well, what happens if Bitcoin has a big downturn to their earnings? And what if the EV credits start to shrink or start to go away? what happens to this company? And, it's trading at just ridiculous valuations, which we'll talk about in a minute. But this just kind of gives you a chart going all the way back to 2010. The return of the stock is in the blue and the revenue growth is in orange. And you can see for 2024, their revenue growth was 1%, but yet the stock went up 63. Even the year before that, it was up revenue growth at 19% with over 100% return on the stock. You have to start at some point to wonder, is Tesla also just one of these ridiculously overvalued companies? And it's the story. People are ignoring, it's not a car maker. It's going to build robots. So there's so much potential. If there's a robot in everybody's house, that's 300 million robots just in the United States. And they may be doing that. They may be the company that does it, but is it going to happen in any time in the near future so that you recognize those dollars? We'll see. I don't think it's going to be that fast. So it's still ultimately an automobile company, even with great technology. And then, the other big thing you say, well, the driverless cars are coming. We're going to have taxi cabs like that. Maybe we will. It's going to take a little bit longer than you think to get that all the way across the whole country, if it works really well. So, when you're buying it right now, you're paying a ridiculous valuation for revenue and earnings that may or may not come. This is a very busy chart on Tesla. If you're really interested in this, when you get to replay, you could come in, stop it, look at it. There's a lot of numbers, a lot of charts, but the big ones are, if you look at the middle column, revenue flat for really, 3-4 years now. Earnings before interest, taxes, depreciation, and amortization, which is called EBITDA. It's actually on kind of a downslide, and it's same with net income. And if you really want to get the numbers, you can see the actual numbers on the right side of the screen. I'm sorry, left side of the screen. So, like I started off talking about Howard Marks and trying to talk about what really is the return. You are buying a future stream of earnings when you invest in something, whether it's a rental property, a bond, a stock, whatever. That's what you're looking at. So for stock investors, there's really three components that are driving your return. The first one is, what's the dividend that I'm going to get from the company? That's the first piece. The second piece is, what are the projected earnings growth? This is the tough part, because you just never know with a company what earnings are going to do going out into the future. You just have to make a best guess. Now, if you're ever not sure, or if it's a very mature company that's not growing revenues really fast, you could always just say, well, in general, the economy grows, between 2.5% to 3% per year. So you could say, all right, if you're not sure, I'll say 3% for earnings growth, because that's just the general growth of the economy. The third one is that a P&E expansion. What's P&E expansion? Well, P&E again is price divided by earnings. So you take the price of stock, you divide it by the earnings per share, and that gives you a number. Now, there are times when the price to earnings is going up, meaning that investors will pay more for the future stream of earnings. They see the potential there. Now, growth stocks typically have a higher price to earnings because that middle part, the earnings growth, is typically much faster than you're going to see with the general economy overall. They're well exceeding that 3% growth. So you have periods where the price to earnings is going up, and then you could also have it where it contracts, where it goes down. And I always say the way to think about price to earnings is, if you take the price of the stock and you divide it by the earnings per share, that the resulting P&E is how many years it would take you to get your original investment back if earnings stayed the same. Now, obviously, earnings don't stay the same, but if a stock's trading at $40 a share and they have $10, well, let's say $1 per earnings per share, that's a 40 price to earnings. So that $1 would take you 40 years to get back your original investment. Now, if it was $40 price of the stock and they have $5 of earnings per share, it's going to take you 8 years to get your money back. Now, price to earnings is a decent valuation metric, and I really like it. But you also have to remember that earnings growth does play a factor into this. So if a company's growing much faster, a 40 price to earnings today, if you pay $40, it's not going to take you 40 years if their earnings are growing much faster than the economy overall. But even if it's a phenomenal company, it could still take you much longer to get your original investment back, as opposed to a more boring company that's trading at a much lower price to earnings, even if the earnings growth is much slower. So let's take a look at some stocks. And this is all kind of back of the napkin calculations. So here's NVIDIA. The bottom part is their actual reported earnings and what were estimated by Wall Street before. So really, you kind of want to look at the reported to see what they actually were, what the earnings were. But then for essentially 2025, right now, the estimate is $4.45 per share. So we have to kind of go with the estimates in this example right now. We don't have the final for 2024. The reported NVIDIA reports, I think, in February 26th, their final. So we'll know the final number then. But you can see the projection 295 is the estimate for 2024 earnings. And they are expecting a 50% growth rate to get to $4.45 for this year. Now, again, does DeepSeek change that? Are people going to slow up their purchases because of that? 50% is a very, very good growth rate. I mean, it's phenomenal. But you still have to look at the calculation here. So right now, NVIDIA has a 0.3% dividend yield. So really, the dividend yield is not a big factor in this either way. Now, earnings growth of 50%, that's phenomenal, right? That's great. You're like, I like this company. It's a great company. It's growing. But right now, its price to earnings is at 49. So again, let's say the earnings don't grow at all. It's going to take you 49 years. If you pay the current price to earnings of 49, it's going to take you 49 years to get your money back. Now, if it's growing at 50% per year, you can see that speeds it up quite a bit, right? Even if they had 1 year of 50% growth and then went flat, okay, well, take that roughly 50 and knock it down to 25. So it'll take you 25 years. If they could do 50% for each year, if it can continue at that pace, well, okay, maybe 49 isn't outrageous, because if they get 1 year of growth of 50 based on today's price, it's really a 25 price to earnings. And then another 50% brings it to 12.5. So you can kind of see how that works if they were able to maintain 50% growth rate. Now, they're also a close to $3 trillion company. How fast can, when you figure our economy overall, the GDP of our economy is what, 22 trillion. They're already at 3 trillion. How much can one company make up of our entire economic activity? If it doubles again, it's 6 trillion compared to a 22 trillion market. One company. If it was a $1 billion company, you could have that long runway where they could get bigger and bigger and bigger. But when you're already as big as you are, it gets a little bit more difficult. So anyway, when you're looking at these things as an investor, what most people are looking at right now is the potential earnings growth. They don't care about that price to earnings. They're not thinking about it. They're not thinking it might contract. So let's just say right now, let's ignore the P&E If you could get a 50% earnings growth plus 3% dividend yield, 0.3% dividend yield, you're looking at over 50% return. That's phenomenal. But one, are you going to get 50%? But the second thing is that price to earnings. At best, you're going to kind of keep the price to earnings where it's at, close to 50. What if it comes down? What if it comes down to 40? I mean, that's a 25% reduction. So now your total return is at 25% if the price to earnings comes down from 49 to 40. What if it goes to 30? Well, all of a sudden, from where we're at close to 50, if it goes to 30, that's 60%. NVIDIA is now a losing proposition for you. And to put things in perspective, you say, well, 30% or 30 price to earnings, it's not, that's pretty low. It's like, well, the historical average for the market in general is 16. So if you have a 16 price to earnings, you're still, according to, price to earnings only, you're almost 100% over that. Now, I'm not saying NVIDIA would ever get to a 16. That's probably a more developed company because it is growing fast. But, like I said, though, even if we get to a 30, which is still a very high valuation typically for a company, that's a 60% drawdown. So you have to start to wonder, are you really going to get paid that? And then you have another company like Apple. We talked about Apple. Right now, Apple's price to earnings is 40. And that's extremely high for Apple. Even if you look at the history of Apple going all the way back to its founding in the 80s, and if you look at it from when the iPhone came out in 07, all the way up until its growth phase, to 2017, 2018, it was trading at about a 25 price to earnings. And right now it's at 40. And back when they came out the iPhone and they were growing, they were a 50% per year growth company. Right now, if you take them at their word, again, look at this chart. We look at 2024 estimate to 2025. It's about a 10% increase in earnings growth. And it does have a dividend of 0.42%. So even if the P/E stays where it's at, we're probably looking at about a 10.42% return on Apple if the earnings manifest the way it's projected. Again, what if it comes back to its 25 price to earnings? It's historical average. So if you basically take more than a third of it away right there, so you're about 40% reduction in the price to earnings, that's going to overwhelm that 10% earnings growth and the dividend yield. And what if the earnings aren't growing at 10%? If you look at Apple from 2021, the actual reported from 2021 to 2024, Apple is flat. Now they've been spending a lot on AI, so maybe if they hadn't spent that, the earnings would be going up. But when you look at the sale of their iPhones, they were actually down 1% this past year. So their marquee product, and it's same for their computers, same for their iPods, everything, their books, their iBooks or whatever you call those things, MacBooks, or they're flat. Now, it's still a phenomenal company. It's one of the greatest companies out there. But again, as an investor, you have to say, what am I getting for my investment into it? What kind of returns, what kind of earnings and cash am I going to receive? So, when you start to look at it, you start to wonder, is it really, this is a company that's so mature at this point that they're flattening out in their key products. So unless they come up with some new innovative product that's going to drive a ton of revenue, I don't know if 40 P/E is really all worth it. And then we look at Tesla. Okay, so we've talked about them already, but they're at 196 price to earnings. Okay. And all right, they're from 2024 earnings to 2025, it's about a 23% increase is what the market's anticipating. And again, that it may come higher than that. It might go lower than that. So if Bitcoin drops a lot, it's probably going to go a lot lower than that. They have no dividend yield. So you basically, if you can keep this ridiculous 196 price to earnings, you'll get a 23% return on Tesla. You should, as an investor. But I mean, that price to earnings, I mean, even if it came down to 100, that's a 50% drop. And 100 is a ridiculous price to earnings for any company. And the thing, when you look at it from 2021 to 2024, you're not talking about actual reported earnings. You're not talking about a huge increase there. They did have a good number from 21 to 22, but now their earnings have been dropping since then. This is not a company that's actually growing their earnings anywhere near 23%. From 2021 to 2024, essentially flat. So let's take a couple companies that, we're starting to invest in. We'll get a lot more of this with Cale Smith as we go, because Cale really gets into these companies. The Permian Resources, we're talking energy. It's a mid-size, mid-cap company. And I've been saying all along, energy is still the only sector of the economy that's trading at valuations below historical norms. So there's a lot of value in energy. So right now, the Permian Resources, their dividend is almost 4%. Earnings growth based on here, the estimates. and I went from the reported, based on the estimates from 2024 to 2025, it should go up about 5%. That's not real sexy, but that's what the estimates are. And then probably another 5-6% even after that. But the price to earnings is 9.34. So if the historical average for the stock market's 16, and this is trading, it's sizably below that. Well, if it got to the average of a 16, you're really adding over 60% increase just on price to earnings expansion. Now, even if it just stays where it is and we just collect the 4% dividend yield plus 5% growth, you should see at least a 9%. And it's a 9% that's going to be pretty rock solid, pretty consistent, can be anticipated to be around that. And then if you get 9%, and even if you get the P&E up to 11, you might add another 20% onto that. But you have what's called a margin of safety with this. We're pretty sure we're going to get that 9%. And then we might get some price to earnings expansion to give you a little bit of extra boost. And there's not a huge risk that the P&E is going to contract down. There is risk that will happen, but not compared to, say, Tesla that's at 196 with earnings that, while they're projected to be 23%, it's hit or miss. They really haven't been doing that for a while. They haven't seen that since, from 2019 to 2021. So you have a lot more risk with that. Whereas this, you've got a little bit more consistency. Another one we're adding to this is Matador Resources. This is focused more on natural gas. And with basically Biden's restriction of natural gas not being able to be shipped to any other countries going away with Trump, there's now a lot of potential that natural gas prices will come up, but also the amount that we can ship off to Germany, Europe in general, or anywhere around the world goes up considerably. So right now it's got a 1.72% dividend yield. And if we look at their projected fourth quarter, which does come out, their actual reported comes out this week or next, from 24 to 25, we're talking about a 17, almost 18% earnings growth. So even if we ignore the price to earnings, right there, you're getting awfully close to a 20% potential return as an investor. And then if you look at the P&E, currently less than 8, again, half of what the normal stock market of 16 is. So even if it doesn't do anything, you can say, well, I think we won't have much of a contraction here. We're pretty safe on that round, in that area. But what if we get 1 or 2 points higher price to earnings? If it goes up to 10, that's a 20% increase there. So there's a bigger margin of safety, and probably, honestly, a little bit more of a higher likelihood you're going to experience these kind of returns than you would with this more speculative companies. And I'm running a little bit late here, so I'll try to keep this to an hour for you guys. Last thing I'm going to talk about real quick is just, it's interesting. I keep watching gold, and I think gold's telling a tale, and we have to really try to figure out what's happening with it. Gold right now is actually performing better than the stock market overall. It did last year. And what's really interesting is, for one of the first times ever, we have the dollar getting stronger. We have interest on the 10-year treasury going up, but yet gold is going up at the same time. Gold is an investment that it doesn't have a yield. It doesn't have a dividend. It doesn't pay you anything. It just sits there. So usually if you have a situation where your currency, the dollar, is getting stronger, that's bad for gold, because your underlying dollars you could hold are going up. So gold, which is kind of seen as a risk, an inflation hedge against the dollar. If the dollar is getting stronger, usually gold's going down. And then also with the 10-year, if the 10-year treasury is going up and offering you a higher yield, whereas gold has no yield, typically money will leave gold and go to treasuries to get that yield. But we're not seeing that right now. We're seeing the opposite. We're seeing gold continue to do well, despite the fact that usually the two factors that can drive gold down are acting as if they should be driving gold down, but it's not. This just gives you kind of a view back to 2020. The blue line is gold, and the yellow line is the dollar. And you can kind of see when gold's going up, dollar's going down. And when the dollar starts to come up, that's when gold comes down, up until really 2024. And we're starting to see a point with both the dollar and gold going up. So that's just rare. Gold has always kind of just been, it's either an inflation hedge or it's an insurance policy against chaos. It really has served both of those. So is it continuing to go up right now because it sees what the deficits are going to be for the foreseeable future, and it's projecting inflation? So that's why it's going up. Or does it sort of see that, maybe the markets are a little dislocated here and we have potential for chaos? I don't know right now. And it's one of those you won't know until it's all said and done, but it's definitely something to keep your eyes on. And gold at this point is hitting an inflation adjusted level that it hasn't hit since the late 70s, early 80s. So even this is on an inflation adjusted basis, it's getting to the point where it's hitting some peaks that we haven't seen since Jimmy Carter and the first part of Ronald Reagan in office. So it's something to watch. Maybe it's just getting too far ahead of itself and it'll pull back like it did in the 70s, or even like it did in 2010. We'll see. But it's kind of interesting that every one of these other times that gold has come back, like in the 70s, early 80s, they raised interest rates so high that brought gold way down, brought inflation down. And in 2010s, well, then we just had the dollar getting stronger at that point relative to other currencies. But those two factors don't seem to be affecting gold right now. Okay, so as always, lawyers say hi. Please do your own research, all that good stuff. Okay, let's see if we... Okay, not too many questions. All right. Yeah, so, the big thing is to think about it. It takes patience sometimes when you see the tech stocks doing what they're doing, the Mag 7 doing what they're doing, and to say, I'm not going to participate because I know that something's going to come along at some point and disrupt that. In the internet phase, it was high interest rates. Is this one, is it DeepSeek, or is that just going to be a blip? I don't know. But even if DeepSeek is just China BS, and we find that out, but we do know that they have altered the way they approach AI, which reduces the energy that's required to make it function. So that's a given. But the second thing is, I think it could put doubts in investors' mind that we probably don't need to be paying ridiculous overvaluations for these companies when there's probably going to be something that comes along and disrupts it, even if it's not DeepSeek. And then, okay, last good question here. How's the Bastion progressing? Very good. So this is going to be a busy quarter. Just for clients that we've got this next week, I'm going to start sending out new contracts for Bastion. All client fees stay the same. Nothing's going to change. But I have to get a new contract. I also have to get a letter signed. This will all come via DocuSign. I also have to get a letter signed where you're authorizing Picket Fence to move the account over to Bastion. So that'll be the first phase. And then we are going to, in cases that we can, we're going to move from Schwab over to Goldman Sachs. And we'll talk more about that. But that'll be the next one. So we have to, by March 27th, have everything moved, all the contracts signed, everything like that. Don't necessarily have everything moved over to Goldman Sachs yet, but we're going to try to do that to see if we can get everything built out. So you're going to start to see a lot more emails on that front from me. But yeah, everything is progressing very well on that front. And I'm going to be sending out a letter here as well, a letter from Kale, kind of welcoming the Picket Fence clients. And then I'll have some more instructions on what a timeline you're going to see things happen. So yeah, well, thank you for your time, everybody. I've taken up that hour and want to let you get back to your weekend. If you have any questions, please let me know. I base a lot of these Coffee with Kirks from questions I get from clients. So it really actually helps me out when I get those. Thank you very much, everybody.